Good afternoon and welcome to the US Solar Fund PLC Annual Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just simply type in your questions and press send. Before we begin, I would like to submit the following poll, and I would now like to hand you over to the team from the US Solar Fund PLC. Meredith, good afternoon.
Hi, thank you very much and welcome to our presentation for the 2025 annual results. I'm Meredith Frost, Investor Relations Lead for the US Solar Fund here at Amber Infrastructure. Joining me today are Tom O'Shaughnessy, Amber's Head of North America, Dan Watson, Amber's Head of Sustainability, and John Toolings, USF's Head of Asset Management. Tom, John, Dan and I are available to take questions at the end of the presentation, so please submit these throughout using the webinar's Q&A function. This presentation, the annual report, supporting information document, and associated RNS announcements are all available on the company's website, ussolarfund.co.uk. Over to Tom to present the results.
Good afternoon, everyone, and welcome to the results presentation for the US Solar Fund PLC for the 12 months ended 31st of December 2025. My name is Tom O'Shaughnessy, and I'm the lead portfolio manager for the US Solar Fund based here in New York. Amber Infrastructure Investment Advisor LLC is the investment manager of the US Solar Fund, and throughout this presentation I'll refer to the US Solar Fund as USF or the company and to the investment manager as Amber. Now I'll begin here with a summary of the key messages that I hope to communicate in this set of results before providing additional information on the performance of the company for the year. First though, I'll make two general points around the information I hope to convey related to this set of results. Firstly, 2025 has been a year of significant change in the US energy markets, and the US Solar Fund has been impacted by some of the seismic changes in federal energy and macroeconomic policy. I will therefore be speaking specifically to the impacts, both positive and negative, that we've observed during 2025 and provide further guidance on the outlook for 2026 and beyond. Secondly, a key objective of this presentation is to attempt to orientate you all around the operational performance of the portfolio in 2025 and the outlook for 2026. I therefore intend to describe certain aspects of the results related to operational performance in quite some detail. So I'll now begin the presentation and talk to some key messages for the year ended 31st of December 2025. So firstly, it has been a volatile year. We're both proud and pleased that initiatives such as the refinancing, the repayment of tax equity buyouts, and other measures aimed at improving financial flexibility and reducing risk were able to be completed early in the period and, importantly, in constructive market conditions. The decision to reset the dividend and conserve operational cash for the time being is similarly a direct result of our focus on maintaining the financial strength of the company during uncertain times. Secondly, we have made progress in addressing operational challenges. As we'll talk about in detail, many of the objectives set out in our operational remediation plan were completed during the year. Now, other issues that arose over the course of the year have similarly been analysed and then remediated, but did have an impact on performance whilst we went through those processes. We've worked tirelessly to address both the existing and new reasons for underperformance this year, and in the majority of cases, I'm pleased to report that solutions have either been implemented or are well underway. Now, I certainly can't claim to even have contemplated the magnitude of some of the things that are happening in the world right now, or changes that we've experienced here in the US this year. I also did not predict that USF would be impacted by new or previously infrequent reasons for underperformance, such as theft and utility-led outages. Similarly, we aren't able to predict the resurgence of some of these issues, or that the portfolio in 2026 and beyond may be impacted by new problems. The decision being made related to ensuring the financial security of the company are a direct result of our admission that we can't predict this with confidence right now, and as such, we should be reserving cash to address any such issues that arise, at least in the short term. The third key message is that we're actively working to position the company to navigate and to capitalise upon the changing US energy landscape. The scale and the pace of changes to US federal policy have created a more complex and uncertain operating environment. Despite this, the underlying fundamentals of this portfolio remain sound, and the portfolio stands to benefit from some of these changes over the medium to long term. The board and Amber, as the investment manager, have spent considerable time this year discussing the market and opportunities that this may create to maximize shareholder value. And I'm going to go into a lot of detail around that in the middle and the end of this presentation. But in summary, based on the current market dynamics, the board decided not to advance a sales process at this time. However, we were collectively encouraged that some of the trends that we've observed, such as the increased deal flow activity for smaller operational portfolios and a general consensus from potential buyers around increasing energy prices, may lead to an opportune time for a transaction later in the year. I'll return to each of these areas in more detail as we move through the presentation. So turning now to the financial highlights for the year. As of the 31st of December 2025, the company's net asset value is $186.2 million or 60 cents per share. This represents an approximate 4% reduction over the year from $194.2 million or 63 cents per share as at the 31st of December 2024. During the period, $7.9 million of distributions were paid to shareholders, and this includes the Q4 2024 dividend that paid in May 2025 and excludes the Q4 2025 dividend declared today, which will be paid in April 2026. Operational dividend cover during the period was 0.96 times covered. This reflected the underperformance experience during the period and has led to the decision to pause regular dividends that was announced today. Just to clarify here, the Q4 2025 dividend has been reduced from the previous announced target, and the level of future distributions will be determined once there is sufficient visibility of improved portfolio performance and the sustainability of the portfolio's cash generation. Total dividend cover during 2025 was 1.2 times cover, reflecting the one-off cash flows during the year, including refinancing and the associated proceeds. So looking ahead, the level of future distributions will be determined once it's been proven out that the combination of factors that led to underperformance and reduced operational cash flows in 2025 is unlikely to be repeated in 2026. We believe this represents a prudent and disciplined approach to capital allocation in the current environment. On an IFRS basis, the company recorded a loss of $49,000 for the period compared to a loss of $34.8 million in 2024. This was primarily driven by movements in fair value of the underlying investments. Gross asset value per megawatt installed, a measure that allows us to compare broadly across the portfolio and other similar portfolios of assets, remains stable at approximately $0.7 per megawatt. Gearing also remains stable at approximately 40% of total gross asset value, and that's following the refinancing. So shifting now to operational metrics, and just to remind everyone, the portfolio comprises 41 assets with a combined capacity of 443 megawatts. The total generation for the period was 676 gigawatt hours, down from approximately 700 gigawatt hours in the prior year. Now, despite this, the portfolio continues to deliver meaningful environmental benefits. In 2025, for example, the assets displaced approximately 434,000 tons of CO2, equivalent to powering around 65,600 US homes or removing 103,400 cars from the road. The weighted average remaining tenor of the contracted offtake agreements reduced over the period from 10.9 years to 9.9 years. Now that's expected given the passage of time and the absence of new contracts being signed during the year. And the substantial majority of the portfolio's revenues do remain contracted under fixed price power purchase agreements over the next decade. This provides a high degree of visibility and underpinning cash flow stability. But as contract tenor reduces over time, the portfolio gains increase exposure to longer-term power market outlooks. This creates an opportunity to capture this upside through recontracting as the current agreements expire. The average counterparty credit strength remained unchanged at BBB+. And now against that operational backdrop, and in response to the challenges and opportunities that I've mentioned in the opening of this presentation, I'll turn now to the key actions that we've undertaken during this year. Now, I'm going to mention some of the key actions undertaken during the year that were aimed at creating financial flexibility and reducing risk. And the first of those is the refinancing. As mentioned in the outset, this was a critical milestone. New portfolio level financing was secured, removing refinancing requirements that were in place on the existing debt facilities that would have needed to be refinanced across 2026 through 2028. This has eliminated a significant near-term risk, and importantly, the refinancing was executed in the first half of the year, and as I said at the outset, in constructive market conditions. This strengthened both financial resilience and flexibility going forward. The second point I'll make here is around tax equity buyouts. We completed a number of tax equity buyouts during the year, most notably across the Realis and Olympus portfolios. And this again has simplified the asset level ownership structure and improved the long-term financial flexibility. We've also undertaken a number of measures this year, including a property tax review across the portfolio. This was a reasonably long-winded process to try and challenge some of the property tax assessments that we had on key assets. We'll continue to proactively seek to undertake exercises like this to reduce or stabilise operating costs. But in this instance, we're able to clarify the applicable tax treatment, and that led to lower property tax bills and, again, improved long-term cash flow visibility. And finally here, I'll add the decision to pause the regular dividends. Again, the decision to reduce the Q4 2025 dividend has been taken as a result of the lower than forecast operating cash balance, and that's due to generational underperformance in 2025. The level of future dividends will be determined based on the visibility of improved performance and cash flows. The board and Amber have undertaken scenario analysis related to the causes of underperformance during 2025 that were outside of the control of the company and the impact of those recurring in 2026 and beyond. We believe that prioritising the financial strength of the company and avoiding a situation where the company could be forced to enter a sales process or undertake some kind of strategic restructuring is believed to be the right course of action given the feedback of advisors and our own analysis of the market at this time. So moving now to slide 9 and the technical outages. Now I'm going to run through these by cause, and looking at the breakdown of the technical outages, there are a few points to highlight here. Firstly, despite the overall deterioration in performance from negative 6.1% in 2024 to negative 11.3% in 2025, the unplanned outages, once adjusted for downtime related to capital initiatives and work that we've undertaken during the period, actually marginally improved. Now, I'll talk through the contributors to unplanned outages shortly to provide more detail, and John, who is on the line here, will provide project-specific commentary on the progress we've made on addressing outages in the next section of this presentation. Now, as can be seen from the table on slide 9, this year saw the emergence of issues that we'd not previously seen as significant contributors to underperformance. Most notably, those relate to the increased incidence of grid outages, and secondly, theft-related incidents. Now, the increasing grid-related outages during the period, especially in the first half of the year, are believed to be a result of elevated levels of safety shutdowns by the grid operators due to recent wildfires, storms, and other extreme weather events nationwide here in the US. There was a process that grid operators went through based on their concerns and their operation of the grid, that we think we're now through, and John will talk to some specific adjustments that we've made across the portfolio that we believe will help lower the incidence of grid outages going forward. Having said that, there is an element of the grid outages and the incidence of those happening that we're not able to control. Similarly, the increase in theft is believed to stem directly from the rapid increase in copper prices that we've seen here in the US and indeed globally. Now, both of these were new pressures on the portfolio and had a meaningful impact on performance during the period. Again, as shown in the chart here, though, the performance in relation to both of these factors did improve in the second half of the year. And we believe this reflected proactive asset management, but also simply a reduction in the incidence of these outages due to external factors. Now, we hope that the work undertaken by the asset management team here in simple acts like prosecuting those who went onto our sites and stole copper, but also installing deterrents for thefts on site, will reduce the impact of theft-related incidents going forward. But we're also hopeful that the work that we've done in finding solutions to address the more than frequent than expected grid outages will continue to be successful, and that more generally, the lower incidence of these factors occurring over the second half of 2025 will continue in all future periods. We'll, of course, continue to report on these factors in future periods, again, hopefully demonstrating that they're no longer significant threats to the performance of the portfolio as they have been during 2025. So now turning specifically to the largest contributor to outages overall, and that is unplanned outages. Now, overall, as I said, unplanned outages increased in 2025. And in addition, there was a deteriorating trend between the first and second half of the year. However, it's really important to note that many of the drivers of underperformance during 2025 were, we believe, non-recurring in nature. Underlying performance excluding these factors did show modest improvement, and we do feel that the remediation plan that we had in place at the start of the year was enacted in a way that improved performance. But if I will then go through some of the additions to underperformance just to describe in a bit more detail things that we observed and things that impacted the portfolio during the year. So as can be seen on the slide here, of the underperformance in 2025, 2.4% was a result of work undertaken or poor performance prior to work being undertaken across a subset of the portfolio that we'd previously identified as requiring capital expenditure. These projects that we refer to as capital initiatives have almost all been completed during the year. If we remove the underperformance related to capital initiatives that have now been completed, that would recover around approximately 1.3% of the underperformance. And that's why I say that we would be on an adjusted basis in a negative 6.6% position, which would be a slight improvement upon last year's unplanned outages. However, I'll quickly say that in our review during 2025 of the projects that we tagged for capital initiatives, we have, as a group, along with the board, analysed a number of those projects to be uneconomic at this point in time. And therefore, there is a remaining 1.1% of the underperformance related to capital initiative projects that will be a long-term reduction to forecasts, and as we'll go on to talk about in subsequent slides, will reduce forecasted generation across the portfolio in all future years. Now, 2.6% of the 7.9% underperformance was linked to specific instances where inverter repairs were delayed due to supply chain issues that we now believe to have been resolved. Basically, these delays were attributable to delays in receiving technical support from providers, and we believe that that's linked to challenges and changes resulting from the One Big Beautiful Bill and federal policy here in the US. Now, John will talk to the specifics here, but overall, we see that there's been quite significant fallout from the rapid changes in policy here in the US. And whilst those are now working their way through, that does pose additional risk as we move into 2026. So the types of issues that we've experienced with OEM providers are something that we do need to actively manage going forward. And I'd note here that we released a white paper in February that also gave greater insight into some of the impact on our supply chains that relates to the One Big Beautiful Bill and federal policy here in the US. Finally, 2.9% of the total 7.9% of unplanned outages related to low-level unexpected outages or instances where we've proactively taken assets offline in order to undertake remedial works aimed at improving their long-term performance. In connection with this, we advanced a number of our remediation plan portfolio-wide initiatives aimed at reducing outage durations, strengthening contractor oversight, consolidating O&M activities, and further improving our spare parts inventory and technical capabilities. Overall, I'd say the outages experienced during 2025 can be attributed to a mix of remediation work, poor performance on assets on which remediation work has been planned or has been undertaken, or theft and grid-related outages. Now, I think I'll pause here and make the point that we have, in this period, in this set of results, responded to the requests of a number of shareholders to provide a much more granular near-term forecast for outages and performance expected across the portfolio. We do recognise the need to distinguish between unplanned outages and outages that are reasonably likely or certain to occur. And a great example of this would be the result of scheduled capital works. And we've sought to provide this information in the current set of results. So going forward, our forecasts will be much more deterministic and will be providing significant detail on the near-term remediation plan, any costs associated with that plan, and the operational impact of things that are in our control, such as those capital improvements. These more detailed forecasts are included in this set of results, and I'll talk to them in more detail in the coming slides. But I would also make the point that that is the only area where we have sought to deviate from the long-term forecast provided by expert external advisors as recently as September 2024. It's this granular approach to the near-term planning that we have implemented within this set of results. On page 11, I'm going to talk a little bit about changes to energy trade and economic policy. Now, as I've said in the prior section, a large number of the issues experienced during the year are believed to be linked directly or indirectly to heightened uncertainty across the US energy market, driven by a broad reset of federal energy trade and economic policy. In particular, legislative developments such as the passage of the One Big Beautiful Bill has reshaped the landscape, affecting the strategy and business plans of companies within the solar and renewable sector, global supply chains, and demand dynamics across the US energy sector. Some of the changes in the One Big Beautiful Bill, specifically the removal of tax credits for some renewable projects, are partly a cause for the increase in long-term energy price assumptions that we've seen over this year. These increases, which are also a result of increased energy demand generally here in the US, have resulted in an increase in the NAV of the fund in the current period. However, a number of the changes have had a direct and in some cases immediate effect on the operating environment for renewable assets, including this portfolio. The magnitude of the changes was perhaps unexpected by most in the market, and the biggest impact that we've observed this year was a fundamental shift in some of the business plans and strategy of many renewables maintenance companies and component manufacturing companies. The service impact of these and the repercussions of the changes to policies were palpable, and it's fair to say that the impacts are still being felt and still being assessed by many in the market. Specifically, we observed instances of poor performance or reduced service that we believe to be directly linked to service providers pausing to reconsider their business models as a result of the changes in the One Big Beautiful Bill. And this was unexpected and difficult to manage. As a result, the year has been characterized not only by operational challenges, but also by a shifting sector-wide external backdrop. And many in the sector have struggled with the lack of near-term visibility and increased volatility. So whilst the outlook for both power prices and the investor appetite for operational solar assets may improve as a result of the changes to energy and trade policy, it's also not assured that there could be further changes in policy and increased levels of volatility that may impact us and be something that we have to address and deal with proactively during 2026, as we have successfully done in 2025. I'll now turn specifically to the financial performance during the year. As previously noted, the company's NAV has reduced from $194.2 million to $186.2 million compared between the 31st of December 2024 and the 31st of December 2025. Now, I'll briefly summarize some of those movements in NAV. First, the dividends paid in the period reduced NAV by $7.9 million. There were updates made to property tax, operating costs, and short-term inflation assumptions that led to a net decrease in NAV of around $1.5 million. Changes to the generation assumptions reflecting the impact of revised generation forecasts in the near term reduced NAV in the period. Portfolio-wide generation forecasts for 2026 and 2027 have been adjusted in line with that more detailed and granular forecast for outages and remediation works requested by shareholders. And in addition, we've made permanent reductions to the assumptions related to 3 projects, Four Oaks, NC Solar 1 and Gauss, where previously identified capital initiatives have been assessed to not currently be economically viable. Changes to the merchant curves used to forecast future energy prices for the future uncontracted electricity produced by the portfolio increased over the course of the year. As alluded to during the interim results, this increase has been due to strengthening electricity demand in the US and constraints on the development of new generation capacity post the passing of the One Big Beautiful Bill. Discount rates during the period were comparable to last period at 10.8%. There was a very small reduction in base rates that was offset by an increase in the asset-specific risk premium. And all of those put together mean that the total NAV decreased by about 4.1% over the period. Now, I'll dig into a few of those items in a little bit more detail, starting with revised generation assumptions. The revised generation assumptions led to an $11 million reduction in NAV during the period. And page 14 provides a breakdown of the forecast made for generation over 2026, 2027 and future years based on the detailed build-up from individual project remediation schedules. As noted in the operational summary projects, a number of the capital initiative projects have been assessed as uneconomic, and therefore a contribution from these projects has been substantially impaired in all future years. And this leads to a 1.1% reduction in generation assumptions in 26, 27 and in all future years. Projects that are undergoing capital initiative works that are yet to complete contribute to a 0.7% reduction in generation forecast during 2026. And we do expect to complete all of the capital initiative projects during 2026. The portfolio-wide performance reduction of 6.1% in 2026 relates to other non-capital initiative-related planned work and the remediation of the remaining projects experiencing issues with OEM supply chains, as well as grid outages returning to normal levels. And in 2027, the forecast underperformance in this category relates to projects that are scheduled for additional remediation works as part of our ongoing remediation plan. So in putting these forecasts together, the board and the manager have sought to take a scientific approach, including the impact of underperformance from known events or project plans, but not building in contingency or buffer for items that it's not possible to forecast with any degree of certainty. This approach means that the portfolio overall continues to align with the generation forecast provided by specialist advisors. And as I said, that exercise was undertaken as recently as September 2024. Other than where the manager has specific reasons to depart from these forecasts based on the individual asset maintenance or remediation plan. So looking briefly now at the NAV movement related to energy price forecasts. Overall, merchant curves contributed an uplift of 7.7 million to NAV between December 2024 and December 2025. Over the course of the year, forecasts of energy prices have increased over the medium to long term. And this reflects a number of things. Higher demand due to data center penetration and electrification in the US, stronger gas price assumptions, and an increased requirement for thermal generation. But also the energy price curves used to forecast future energy prices moved significantly in the second half of the year due to the assumption of lower long-term penetration of renewables as a result of the changes made by the One Big Beautiful Bill. Now, an important point to make here is that the company sources its merchant forecast from two leading market consultants and applies an average of their last two curves, one from the first half of 2025 and one from the second half of 2025. The current valuation therefore considers one data point taken from before the passing of the One Big Beautiful Bill and one from after the passing of the One Big Beautiful Bill. Now, obviously, as we roll into 2026, we will be using two data points, both from after the passing of the One Big Beautiful Bill and also including any changes that have occurred during the first half of 2026 when preparing our forecast for energy. Now, looking specifically at portfolio discount rate, the portfolio discount rate had only a very small impact on the NAV during the period. As I said, there was a 0.1% increase in the equity risk premium, which was offset by a 0.1% decrease in the risk-free rate, which is based on the 20-year US Treasury yield. And I'd note that the US Treasury yield has been particularly volatile over the period. The modest increase in the equity risk premium reflects KPMG, the independent valuer's updated view of market conditions, and they incorporate within that review operational performance, recent transaction activity, and observed discount rates in the market. Although the overall discount rate is broadly unchanged period on period, changes in the asset level weightings resulted in a very small positive valuation uplift during the period. So moving now to talk to dividend cover. As I said in the summary at the outset, operational dividend cover for the period was 0.96 times covered, and in 2024, this was 1.1 times covered. The operational dividend coverage metric seeks to reflect the sustainability of the level of dividends payable by looking at underlying cash generation from the portfolio, and that excludes significant one-off costs and incomes not expected to be recurring in nature. When adjusting for those one-off cash flows, such as the inclusion of the excess refinancing proceeds, total dividend cover for the period improves to 1.2 times covered. Now, on the right-hand side of this slide, we've included for illustrative purposes the impact of the underperformance during this year, or just an indicative case that shows the impact of improved revenues and those falling through to dividends in any particular period. Turning now to operational performance, I'll, again, as I have done in previous presentations, provide an update separating weather and non-weather related factors. Now, the chart on the top of this slide shows the long-term weather variance relative to forecast assumptions. As a reminder, underperformance indicates that solar resource assumptions were too aggressive, while overperformance suggests that they were too conservative. For a portfolio of this nature, we'd typically expect to see variance of around plus or minus 5% around the mean over time, with a long-term average aligning with forecast generation. That would indicate that the underlying assumptions are broadly accurate, and that's what we see across the USF portfolio. In the current period, overall weather variance was marginally negative at approximately 0.4%, and this reflects stronger than forecast irradiance in the first and fourth quarters, offset by weaker irradiance during the higher production second and third quarters. Regionally, there was some variation. Precipitation in Utah, North Carolina, and Oregon was below average in 2025, while temperatures remained elevated relative to historic averages, and that negatively impacted performance due to higher heat losses. In contrast, California experienced above average irradiance throughout the year. Now, the second chart shows the portfolio's long-term performance excluding weather-related effects, and therefore isolates operational performance across the portfolio. Over the last 12 months, the portfolio underperformed by 11.3%, bringing the average variance since IPO to negative 4.6%. And this negative variance continues to primarily be driven by unscheduled outages. As discussed earlier, addressing underperformance caused by unplanned outages and improving the overall reliability remains the company's immediate operational priority. I'll now hand over to John to walk through some of the portfolio performance and the remediation actions in greater detail.
Thanks, Tom. As Tom mentioned, the portfolio's performance from non-weather related factors was negative 11.3%. A meaningful portion of this underperformance was driven by unplanned outages, as well as several themes that are relatively new to the USF portfolio, such as theft and grid outages. As we flip over to page 23, we will talk through the technical outages that were the primary driver of losses across the portfolio in 2025. The majority of negative variance was attributable to the performance of the Heelstone and Granite portfolios. These portfolios were primarily impacted by technical issues previously identified, as well as external factors outside of the company's control. Approximately half of the 11.3% variance was attributable to 7 assets, while 70% of the 11.3% variance was attributable to 15 assets. Taking these assets in turn, we first look at Turkey Hill. Turkey Hill has 4 central inverters, of which had a blown IGBT stack, taking 25% of the site offline. T-Mike, the manufacturer of the inverters, has lead times upwards of 6 months for such parts. Also, at Turkey Hill, and similar to other assets in Oregon, grid outages were most impactful in the first half of the year and reduced in the second half due to the diagnostics and remediation plan. Grid outages derived from voltage imbalances coming from the grid caused the site equipment to do as it's designed to do, trip offline in order to protect equipment downstream on site. As a solution, and in conjunction with the utility, we were able to adjust our site settings to accommodate the grid voltages, yet still protect our site equipment. This has led to a reduction in grid outages across the Oregon projects. At Chiloquin, we have gophers that chew through the underground feeders, causing inverters to fall offline. Throughout the years, we have exhausted all possible extermination strategies, which has led us to the capital initiative. Digging up the feeders and repairing them just for the feeders to then get chewed on again by gophers is labor intensive and not a long-term solution. Therefore, we are underway with the capital initiative plan to install above ground feeders for each inverter. There are 165 inverters on site, so this is no small task. Chiloquin also had the grid outages as discussed at Turkey Hill, which have also been reduced through the diagnostic and remediation plan as discussed. Milford operates generally well, but given its sheer size and relative to other assets, any loss is significant. In Q4, there was a transformer-caused site outage that was quickly remediated through an available transformer procured through the spare part strategy. Without having the spare transformer, the outage could have been isolated to one of the 27 inverter skids. However, lead times on transformers are 6 to 12 months. With the faulty transformer removed from service, the team was able to repair it and it is now considered a spare part. At Gauss, there's two main problems. One being the capital initiative related to unreliable utility communications, causing the site to frequently trip offline, at times multiple trips a day. The team is always quick to respond, but given the frequency, it does have a meaningful impact to production. The second issue is the lead time from the inverter manufacturer, Schneider. Unlike other brands, the technicians are very limited on what they can diagnose and remediate within the Schneider equipment. With Schneider, any technicians, not just ours, are heavily dependent on Schneider to diagnose and dispatch the site. This has long lead times, it is costly and inefficient. At Granger, we completed the capital initiative work in the second half of the year. This work, combined with the same capital initiative plan for Valley Center, replaced around 200 Huawei inverters that were no longer serviceable. Since completion, we've seen expected increase in production, and I will go into more detail on other capital initiatives on the next slide. Once we got all the inverters replaced, we were then able to properly diagnose and remediate the DC underperformance, which was completed in 2025. At Jersey, generally a decent performer, the performance was impacted by copper thefts in this past year. The remediation is time consuming and has taken resources that would have otherwise been used elsewhere in the portfolio. As a result of the impact from theft from sites more generally across North Carolina, we've implemented deterrent strategies through camera installations, working closely with police departments and prosecutors, opened lines of communications with other asset owners. At Four Oaks, this is a site where we've reviewed the capital initiative work. Eaton, the inverter manufacturer, no longer supports their solar division, so we, along with other asset owners, rely heavily on third-party markets to find parts. Where we have been successful is to find out who makes the specific parts for Eaton, then work with that specific manufacturer of compatible parts and find replacements to put inside the inverter. The parts, because they are not direct replacements, then need some level of fabrication to make them compatible. An example of this in 2025 was something as small as a temperature sensor that needed to be procured, recalibrated, and slightly fabricated in order to restore the inverter. Moving down to Merrill, it has similar issues to Dairy and Lakeview, so I'll group those together. Similar to the other Oregon sites discussed like Chiloquin, Merrill, Dairy, and Lakeview were impacted by utility-caused grid outages. As noted, we worked with the utility to change site settings in order to reduce the impact of voltage imbalances coming from the grid, of which we saw a great improvement in the second half of the year. These sites also needed tracker replacement parts that had long lead times from the manufacturer. Upon receipt of those parts, the manufacturer then needed to come to site to commission the parts for those parts to work. This is not typical practice, but something specific and a newer practice from the manufacturer. At Tumbleweed, this site is located in northern Oregon, which does not have as big of an impact from grid outages as the southern projects. However, was impacted by long lead times on replacement panel board parts. Items such as the bus bars and various fuses and switches were, which had a lead time of over 6 months. As soon as those parts were received, we put them into the panel board and got the site back up and running, and is now meeting our expected generational figures. At Sone 2, through the diagnostics and remediation plan, we identified accelerated degradation of the DC fuses and fuse harnesses. As such, we reviewed and implemented a solution to replace the failed components, but also proactively replace the rest of the site components to prevent future causes of underperformance. Now that that is completed, the performance numbers have been much better. At Pilot, a project within the Olympus portfolio, we experienced similar grid outages like we saw in the Oregon fleet. As such, we are in conversations with the utility in an effort to reduce the impact of utility voltage imbalances. Also at Pilot, it's worth noting we had several inverter outages within the period. Those have all since been remediated. In late 2025, the O&M provider's contract expired, so we took the opportunity to recontract with a different provider, of which we have much better expectations, and we look forward to the other technical and technician support. At NC Solar 1, theft was also an issue similar to Jersey. The same theft deterrent strategies were applied at this facility. The remediation was covered under our insurance program and is now complete. Also in 2025, we completed a warranty claim with the module manufacturer Trina. The Trina modules have accelerated degradation that heavily impacts site's generation ability. The capital initiative to replace those modules have not turned out to be value accretive. Princeton has the same inverters as Four Oaks. Eaton is the manufacturer. Although performance at Princeton has generally been better than Four Oaks, the team has the same issues that we talked about with Eaton, and we look for other avenues to source and replace parts. On page 24, we'll talk through the capital initiative works that have been underway. As noted earlier, of the 7.9% unplanned outages, 22.4% were related to 7 assets previously identified needing capital investment. Details of these initiatives are shown in this table. Remediation has been completed at the Granger and Valley Center facilities, resulting in improved operating performance. In addition to completing this work, over 200 removed inverters were recycled and put into our spare part strategy for Sudbury and Tiburon, which are located in North Carolina. Those extra inverters will support their long-term availability at the Sudbury and Tiburon assets. And although we haven't seen the level of failure at the North Carolina sites, we did replace 4 of the 367 inverters in 2025. At Chiloquin, remediation has been approved and is ongoing with the completion expected in 2026. As mentioned in the previous slide, gophers chewing on the underground feeders causing inverters to go offline, in which we are now bringing those feeders above ground. At Phase-On, analysis to date has not demonstrated value accretion. However, additional options continue to be assessed. For the remaining 3 assets shaded in dark green, Four Oaks, NC Solar, and Gauss, further capital investment is not currently expected to bring value relative to the required expenditure. Before I hand it back to Tom to cover the changes to generation assumptions, I will briefly conclude on operational progress. While 2025 presented a number of challenges, we have made tangible progress across the portfolio. Our spare part strategy is delivering measurable improvements, and enhanced oversight and data analytics are supporting faster fault identification and resolution. While the remaining manufacturer-related issues are expected to be resolved in the first quarter of 2026, we enter the year with improved operational visibility and confidence. While overall the actions taken during 2025 have strengthened the operational foundation of the portfolio and positioned the company to deliver improved availability and more consistent cash generation going forward.
Thank you, John. So with those details covered, I just want to revisit the revised approach that we've taken to generation forecasting. At a portfolio level, generational forecasts for 2026 and 2027 have been revised downwards to reflect the specific plans and schedules for the underlying projects that John just talked to. This is important as some of the projects will continue to go through remediation during those years, and the revised forecasts therefore include the downtime related to these activities or the assumed underperformance prior to that work being done. Specifically linking some of what John discussed to the forecasts here on the following slide, slide 25. Firstly, the dark green bar is the long-term reduction that's been factored into the forecast due to the expectation that Four Oaks, NC Solar, and Gauss Solar, also in dark green on the prior slide, are not expected to be undertaken. Capital initiatives at Granger and Valley Center were completed in 2025, and Chiloquin and Phase-On's capital initiatives are expected to follow in 2026. The lighter green bar, and sorry, Chiloquin is underway at the moment, so I should clarify that. The lighter green bar shows any downtime or underperformance planned in relation to those works. And finally, the lightest bar here shows the combined forecast impact of the multiple remediation works planned across the wider portfolio, or the downtime that's been factored in before those are undertaken for the remainder of the USF portfolio. Taken together, these updates represent a prudent and, we think, realistic view of forward performance, grounded in observed operating data and current expectations, whilst not departing, importantly, from the long-term forecasts validated by our external advisors. So I hand it over now to Dan Watson to make a few points related to responsible investment.
Great, thanks very much, Tom. So I'll start with a broader point on the role of solar within our strategy. So solar generation sits at the intersection of energy security and climate mitigation. It provides domestically sourced low-cost power, reduces reliance on imported fuels, and plays a critical role in accelerating the transition to a low-carbon energy system. As Tom mentioned, in 2025, the assets displaced approximately 434,000 tonnes of carbon dioxide equivalent, which is the equivalent to powering around 65,000 US homes or removing 104,000 cars from the road. Now, this structural demand for clean, resilient energy underpins our investment thesis, and against this backdrop, the company continues to draw on UN Sustainable Development Goals to demonstrate the positive environmental and social characteristics of the portfolio. Further detail on our overall approach to sustainability is provided in the annual report, but I will highlight a few key developments during the period. Starting with non-financial disclosures, we have strengthened our ESG data framework by increasing the incorporation of formal data collection requirements into USF operations and into management company contracts. Although we have had to increase the estimation of data whilst we transition contracts during the period, it will lead to improved consistency and quality information we receive across the portfolio. Data is gathered and processed internally by the asset management and ESG teams, enabling us to produce reporting aligned with the Sustainable Finance Disclosure Regulation, or SFDR. And as a reminder, USF is not currently required to comply with the UK sustainability disclosure requirements, but we continue to monitor developments in this area. On climate risk screening, we have updated the TCFD physical risk section to reflect the introduction of a new risk-based screening tool. This tool uses catastrophe hazard data together with asset-level financial inputs and operational assumptions to estimate potential downtime, revenue disruption, and residual loss across the portfolio. The output will be used to guide further investment assessment and risk management, while recognising that the portfolio continues to benefit from robust insurance cover. And finally, on community engagement, across the portfolio, project budgets include dedicated allocation for community engagement activities. During the period, USF donated $500 from each of 4 projects within Heelstone, County Home, Fremont, Mariposa, and Son 2, totaling $2,000. And these projects are located within the Hurricane Helene impact region west of Charlotte in North Carolina. In addition, the company made a further $500 donation to North Carolina Crime Stoppers and $500 to Back the Blue charity. Overall, these actions reflect our continued focus on strengthening ESG reporting, improving climate risk assessment, and maintaining positive engagement with the communities in which we invest. And with that, I'll hand back to Tom.
Thank you, Dan. I want to be mindful of the time here and certainly leave time to answer some of the questions that have already come in, but also any additional questions. So I'll turn now to the priorities for 2026. Our priorities for 2026 are focused on execution across 3 areas. First, financial resilience and discipline. Based on the refinancing, tax equity buyouts, reviews of insurance and property tax, and the reset of the dividend, the company is, in our view, in the best position possible entering 2026 in terms of balance sheet strength and liquidity. We do intend to keep the dividend capacity under constant review as visibility over sustainable cash generation improves and begin progressing our recontracting strategy from the end of 2026. Second, restoring and enhancing operational performance and reliability. The operational challenges experienced this year have been explained in detail, both here and in the report. And the focus now is on continued delivery and managing any new or recurring risks. We've proven, hopefully, our ability to do this successfully in 2025, despite the impact of those new issues on performance during the year. But we now need to continue to focus on reducing outage durations, improving response time, and overall increasing our ability to proactively manage these new risks and new challenges as they occur. Our feeling is that we may not have seen all of the changes that are going to happen under this administration at this point in time. So we need to stay fleet of foot and be able to deal with that. Now those activities are supported by increased in-house technical capability that we've taken on during the year, more proactive supply chain management, managing others who are similarly dealing with some of the challenges that have been presented during this year, and then better use of data and analytics to drive faster resolution and more consistent outcomes. Together, these actions are aimed at improving both performance and reliability across the entire portfolio. And third, really importantly, we're positioning the portfolio for value realization. Now, we've spent considerable time this year working with the board to keep constantly abreast of the rapidly changing market dynamics. The board were here with me in New York in November, and earlier in the year, we've continually revisited the outlook for the US solar sector and indeed global renewables, with a keen focus on trying to ascertain whether our criteria for launching a sales process or working with particular advisors to investigate a sales process is timely. Now, we have observed during this period a greater number of transactions taking place in the solar sector related to smaller portfolios. And as a result, we sought direct input from several market experts to consider options for the marketing and sale of the company. The feedback from those market experts indicated that the majority of the transactions that are occurring currently are motivated either by distressed circumstances and are hence not representative of how the USF portfolio may trade, or are larger transactions involving partnering or sell down of the US operations of larger strategic companies. That's either in reaction to the One Big Beautiful Bill or for other reasons. And USF falls into neither of these categories. However, and positively, the views on factors such as escalating energy prices and the shortage of operational assets is generally seen by these market experts as a good indicator of the future appetite and value that could be achieved for assets and portfolios similar to USF. So the board and the manager generally believe that a non-distressed or forced sale at a time when there is an excess of capital or shortage of projects represents the right environment to consider a sale or similar strategic options. Through improving the quality and quantity of the information that exists in the public domain in the meantime, and ensuring that the company is fully prepared to act if opportunities emerge, we feel that increases the likelihood that such circumstances could arise, although I want to make clear that the board's decision was to not pursue a sales process at this time. Taken together, these priorities are designed to reinforce resilience, deliver more consistent and reliable performance, and create a clear pathway to longer-term value realization. And at that point, I'll conclude the presentation portion of this and hand it over back to Meredith to open up the Q&A.
Very much, Tom. So onto the Q&A section of the webinar. As Tom says, we've had a number of questions come in already. Thank you, although I think we may have dealt with some of these as we went, but please do continue to submit them and we'll start to work our way through. Starting on the portfolio, there's been some questions about the performance and how it might improve. And there was a specific question here about if there's an opportunity to optimize the portfolio through selective asset sales, repowering, or operational enhancements.
It's a great question, and I might take those in reverse order. So operational enhancements, certainly, yes, that's what the remediation plan is focused on. We spent a lot of time, both from a desktop perspective, looking at the analytics, but also on site with John and his team, working to try and optimize each individual asset. And John went into some detail there around issues that we still see and issues that we're trying to fix. So that's really our main focus. We certainly, back in 2023, when we took over the management of the fund, considered repowering as something that we potentially could look into. The same with co-location of battery energy storage, which is a strategy that others amongst the peer group have looked into. Having completed that review, we don't feel that there's a significant opportunity for repowering or for battery energy storage. Having said that, calculation changes day by day as energy prices increase, and therefore there's a constant focus on our side of running the models and seeing if those projects now pencil. I think strategic asset sales, again, is something that we are open to, alive to, consider. We obviously have to contemplate what would happen to the remainder of the portfolio. I think it would be fair to say that the board and the manager's view is that the portfolio sale would be more attractive than the sale of individual assets. But we are certainly open to that and provide much more detailed, and hopefully the group gathered here will agree, more clearer and well presented information to the market, so that anyone who is considering an asset or a portfolio acquisition would be able to understand at least what was available within the USF portfolio. And then the other part of our role has been to ensure that, should we be approached in that way, that we have an ability to provide high quality information to allow a transaction to occur. So we're certainly not trying to prevent that happening as a strategy. Indeed, we're trying to encourage it, but we do want to ensure that we're acting in the interests of the company over the long term, rather than selling one specific asset, which might lead to more of a challenge selling other assets.
Thank you. And then related to that has been a question about if we expect for kind of additional capex to be required to work on some of the underperforming assets.
So the capex that we had allocated to the capital initiatives has already been provisioned for and is in the forecasts. So there will be no additional capex required. To the extent we identify new challenges within the remediation plan, or we experience other issues, those will be analysed on a case-by-case basis. Yes, it's provisioned for at the moment, but we'll continue to monitor any new issues that come up, and certainly haven't, I want to be clear, haven't set aside capital to deal with things that we don't currently know about.
Then moving on to a couple that are more about the renewables environment as a whole. So given the supply constraints in renewables in the US at the moment, how well positioned are the USF assets given their operational focus?
In my own view, very well positioned. I think small portfolios of operational assets, of which USF very much falls into. I'd classify a large portfolio as anything above $1 billion and probably a gigawatt in size. So this does fall into the smaller category, but I think that there is long term now forecast to be just a shortage of these types of asset. We're seeing demand now directly from the hyperscalers, from data centers, from those who need power, and utilities reacting by seeking to procure power that's generated from all sources, but certainly from renewable sources, where a lot of the buyers of this electricity haven't really departed in any way from their commitment to renewable power, maybe in the way that the federal government has somewhat wound back their commitment to that. So we see USF as very well positioned. I think, putting it plainly, last year was a major shock to everyone. I think the magnitude of the changes was not expected, at least by the majority of the market, and it is taking some time for the market to react to that. One of the things that we are keenly focused on as the board and as the manager is tracking who is buying in the space, how they are amassing capital to enter the space, their specific strategy, what they're looking to achieve. And we do feel that, as with any market, there will be cycles, and there is a right point in the process to consider selling USF, based on that supply and demand dynamic.
Thank you. Thank you. And that leads well into our last question, given the time. So I think you have spent plenty of time talking about the market for asset sales and the current state of the market. But there's a question here that asks about our motivation to sell these assets. And I guess in light of the challenges, if we could talk a little bit about Amber's motivation with the company.
Yeah, happy to. And again, it's a great question. That we're very motivated to do the right thing here. I think our commitment to the fund and to shareholders was that we would transition this from the position it was in when we picked it up, let's leave it at that, to something that's more positive and a beneficial outcome for all. That wasn't economically driven. That's driven by our desire to do the right thing. And I'd put some of the advisors of the fund in that same position, that we're just trying to do the right thing and move this on. And we've gone to some lengths to express to the board and to shareholders that we are more than happy to see this transition to a new owner. We have made some pretty substantial improvements in the quality of the information that we have on the portfolio in order to allow that to happen. And really, what we're trying to do at the moment is pick the right point in the market so that outcome is positive for shareholders and for the board and for the company. But yes, highly motivated to make that happen. And I think we as a business would certainly not try and hold on to this, given the economics of it. Should a quality acquisition opportunity or a different strategic option arise.
Great, thank you. That's all the questions answered.
Fantastic. Thank you all very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback, which will help the company better understand your views and expectations. On behalf of the management team, we would like to thank you for attending today's presentation, and good afternoon to you all.